Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today I'm talking with Jay Burr. How you doing today, Jay?
I'm doing terrific, Kirk. How are you doing today?
Doing well, doing well. He also goes by RJ, which we had a little talk about what he prefers, and I might go back and forth in the show, just keep him on his toes. So,
well, it's one of those when you have three older sisters and your dad wants to name you after everybody in the family, you have to come up with something.
Got to be original. That's right.
Absolutely.
So Jay, tell us a little bit about your background. You're in the oil space, so tell us a little bit about your background, how you get into that space.
Some kids grow up watching their dads practice law. Some kids grow up watching their dads practice medicine. I watched my dad in the oil and gas business. When I was 7 years old, I remember him loading me up in the car, and the go to work with dad day, and that was my day to go to the field. And we went to Luling, Texas, and I don't know if you've ever been to Luling, but Luling has a distinct smell to it. And when I got there, I really didn't know what that smell was, and I'm, sniffing around. I said, "Dad, what is that?" He said, "Baby, that's the smell of money." And I didn't quite understand it at that point in time. And then he took me to the field, and I saw all these pump jacks, the metal horses that go up and down.
Yep.
I saw all these pump jacks over on the horizon. I said, "Dad, what are those?" He said, "Baby, every time those go up and down, our partners are making money." And I was hooked. I knew that's what I wanted to do. And finished school at 18 years old, got in the business, earned my first partner 3 months out of high school, and I haven't looked back. This is all I've ever done.
That's awesome. That's awesome. It seems to be a very similar story in your part of the world. There's tons of money to be made if you know what you're doing, and tons of money to be lost if you don't.
No, without a doubt. No, if anybody ever calls you in oil and gas and guarantees you something, they're lying to you. There is no guarantees. Only the good Lord above knows exactly what's down there. You can get all the geology, you can get all the data, you can get everything you want. But until you actually drill that well, you're not going to know for sure. And so it's as my dad used to say, it's not an industry for men in short-legged breeches.
Well, the oil industry's come a long ways from the clampet shooting at a raccoon and hitting oil in the ground and making plenty of money moving to Beverly Hills. That's for sure. How is that?
At least they'd like to convince you that.
Yeah, that never really happened, but certainly it's changed a lot. So how has it changed? Like what's going on in the oil industry now? Like what kind of innovations are going on that are really changing the landscape compared to where it was like 10, 20 years ago?
Well, the main thing is not necessarily, yes, your technology is getting better, but really it's the evolution of the domestic oil industry. When you look at American oil, if you grab the average person off the street and said, name an American oil company, they're immediately going to go to your majors. They're going to go to your Exxons. They're going to go to your large companies. When the fact of the matter is, the domestic production industry is composed of roughly 9,000 independent producers that average 12 employees or less. These guys produce right at 90% of the natural gas and right at 85, 86% of all the oil that is produced in the country. They drill roughly 90% of the wells. And so when you look at the industry in America, that's what it is. It's these 9,000 independent companies. And so that's one of the conversations we have with our partners all the time is why is this moment in time so special? And it's because typically, well, just look back in 2008 when the real estate market crashed. Who came in and picked up all the pieces? They would essentially be your majors in the real estate. Your large, deep pockets came in and started buying up properties left and right. Well, that's typically what happens when a crash happens. Whatever industry it is, it crashes, and you have the larger companies come in and they cherry pick the pieces and pick up what they want. Well, in oil, where it's different right now, the majors aren't doing that. In 2014, industry-wide, worldwide, we invested roughly $900 billion in upstream development. That's finding more oil to replace the oil that we've already produced. That number is going to be lucky to be 300 billion this year. Well, where's that money going? They're not putting it back into the ground. And so when that crash happened here 2 years ago, instead of your large majors coming in and picking up these high value properties, everybody's been running from them. And so we just filled the gap. And so that's really, it's understanding the industry and really understanding the chain of events over the last roughly 60 years that have led to this point. And now we're here. And so the people that actually understand what's going on and have cash on hand, they can do well right now. You really can. I mean, we were discussing earlier, you have a product that the world is addicted to. There's nothing to replace it with. And so
let's kind of dive right in here, because you mentioned a lot of things. You said it went from 900 billion to 300 billion. Why? I mean, there's some obvious reasons here. Why is that not going back into development?
Well, life's been hell since my crystal ball broke. But looking back and looking at motivations, I'd hate to put motivations on people. I don't know why they did. However, when you use common sense, there can really be only one of two reasons. Let's look at the majors. Where are they putting that money? Well, they're putting a large percentage of it in green energy. Now, if you had something to replace oil with, that's where that money is going. Now, what are they putting that money in? They're putting it in solar. Well, they discovered the first solar panel in the mid 1800s. They're putting it in wind. Well, can you think of the little Dutch boy with a windmill on top of the hill? So they're putting money in industries that have been researched for decades. And if they hadn't figured it out yet, what are the odds they figure it out right now? It's gonna happen eventually, but it hasn't happened yet. So you look at this and you say, okay, let's say Exxon, why would Exxon do this? Why would they take this money they're putting in the ground to find more oil and put it in green energy? Well, there can only be one of two reasons. Either one, they're altruistic. One, they're mad at themselves because their company is producing a product that is destroying the planet, and they're willing to wreck their company to rectify that. That's one option. The second option is they see exactly what I see. They're putting their money in green energy. Well, what are they going to get? They're going to get social loving. Everybody's going to call them saviors of the world because they're putting money in green energy. Two, they're going to get tremendous tax benefits for doing it. But the dirty little secret is they know exactly what I know. They know that when the dust settles and it all ends and everybody comes out the other side of the tunnel, there is nothing to replace oil with. Well, what's that going to do to the value of the properties they already hold? And so I don't know why they did it, but I look at the reasons and I can tell you which one I think they're doing.
Right, but I think that's a good perspective. I think what I find interesting is that this green movement is basically going to push up the cost of energy for everybody, especially people who are not well off. Poor people who can't afford, an increase in energy prices. That's going to start hitting them especially hard. So I mean that's a concern. I mean, but aren't some of these other energy prices or energy sources, aren't they going to kind of supplement that, or how does that work? Because oil and gas aren't used for everything, right? You still need...
Theoretically, I mean, theoretically, it's supposed to replace it. But ask those towns in Germany, they're clear cutting their forest right now for wood for the winter. I mean, that's what happens. There's really, I believe all of us have a little environmentalist in. I believe that I love a beautiful, clean environment. I love everything to be pristine and no trash. I mean, that's part of just my love of beautiful things. However, what I want and wish and what is are two completely different things. While I would love for there to be a perfect, clean burning energy that had no emissions, well, just because I would love that doesn't mean that it's there. And there's nothing there right now. Now, when you get into the green side of it, if we really, I mean, I kind of, you go back to, you don't question somebody's motivations, but in the same sense, in this green energy, well, if they truly did want green energy and low emission fuels, they'd go natural gas, nuclear. Those are the cleanest burning energies we have, yet they're running away from them. And so it tells me there's got to be another objective here. Otherwise, it doesn't make sense.
Yeah, that to me has been one of the biggest head scratchers in this whole sector, is that nuclear it solves everybody's problems, right? It's cheap, clean, load energy, and it's environmentally safe. And people are still freaked out about it from the 70s, even though, there have been more problems with every other form of energy than nuclear, but yet there's that one thing that just freaks everybody out. And to me, it's like, you have got the new technology, you've got Gen 4 reactors, everything, and people just, I don't know, there's no political will to push it.
Yeah, well, I mean, I mean, let's just say politicians have been shown to not be the most courageous people out there. And for a politician to willingly do something that enables their opposition to call them polluters of the environment, to call them evil, to call them greedy, to call, they're too worried about being called names than actually looking at what the problems are and trying to solve them. We can go down a whole nother alley when it comes to why they're doing this. From my standpoint, I just kind of look at it and say, honestly, I really don't care why you're doing it. Here's the result of what you're doing. And by doing it, you're creating an avenue for me and my partners that I haven't seen it. I've been doing this 30 years and I've never seen the energy industry like it is today.
So based on what you're seeing, and everything I'm hearing kind of alludes to this, but based on what you're seeing, do you see oil prices going a lot higher from here based on the fundamentals?
You might have, and once again, this is all just kind of there's no scientific, it's more just kind of your gut and watching the world events. I see a crash soon. I see with and that's just really with the slowdown of the world economy. However, we're in a marathon, we're not in a sprint. And so when you see the next couple of years, because that's really what we see coming here. 2 years ago, we saw the crash coming because we saw Russia and Saudi Arabia basically engaging in economic war with our shale industry. And that's a whole nother geopolitical talk. If you want to get into it, we can, but that's really what we saw coming. We saw them pushing prices down to $40, $45 a barrel. And when the industry, that the shale industry out, and especially out in the last 5-10 years, most of them need $50, $55 a barrel just to pay their bills. And so by pushing the price down to $40, $45 a barrel, all of a sudden these companies would be in trouble. And that's what we saw coming. And then all of a sudden COVID came. And while the trigger was different, the end result was the same in the crash in prices. Now, once that all, we figured there'd be about an 18 to 24 month period where everything would be down, where you could go in and you could acquire reserves for pennies on the dollar. And that's exactly what we did. Now, coming out of that, we were thinking grownups would emerge. We were thinking rational heads would come back and everything would kind of close that window. Well, lo and behold, it didn't happen. And so what you have is we see another 12 to 24 months where prices are going to be pushed down because, one, the world's economy is slowing down. And then all of a sudden, it'll come out of the other side because you can't slow it forever. You can't keep the American economy down for long. We're going to figure out a way. We're innovative, we're creative, and we're entrepreneurs. We're going to figure out a way to get our economy going. Well, when that does happen and they've removed all of that oil from the market, well, if you have 10 barrels of oil and demands 100 barrels of oil a day, what do you think is going to happen to the prices at that point? And that's what we're betting on. We're betting that there'll be another 12 to 24 month period that you can do some aggressively acquire reserves. And then when the dust settles and everybody realizes we can't get away from oil, man, everybody's life's dependent on it. I don't know how many people jump into the weeds on the involvement that oil has in your life, but there is not a living person in the modern world that does not have oil involved in their life, from the products that is produced, from your clothes to the plastics to, everything. Basically, if it says poly, it's oil. And so you're like, what, 6,000 products from one barrel? And so you just have a dependence that most people don't realize how vital it is in their life. And if you remove it from their life, I heard a news guy the other night, I think it was Tucker Carlson, make the comment when they were talking about oil. And they were talking about people that were opposing oil. And he just looked at him and said, so what, you oppose the modern world? Because that's essentially what oil has created. And you don't want to be greedy and selfish because it's my industry and I want to brag on oil. No, I'm just looking at the facts. When petroleum was introduced to our society back in the 50s was when it was really first heavily introduced. Our world has completely changed. Every economy on the planet is driven by energy. Well, energy is oil and natural gas or coal. Now they're trying to go in different routes. You have nuclear plants, you have other avenues, but the main staple is coal, natural gas, and oil. And we can't get away from it. I mean, what you saw on the news the other day, they had a computer that did the first simulation of fusion. Well, how long between that first simulation and an actual working model? What's the time lag between those two events happening? Well, until something like that does happen, it's going to take a printing press type invention. Those don't happen very often. And if it would have already happened, knowing human nature like I do, well, ask yourself this, Kirk. If you had created the greatest invention since the air conditioner, would you be quiet about it?
Yeah, I mean, the thing I wonder about is, and I'm curious, I want to get your definition of a crash, because I guess I'm curious about that. But if big oil, and maybe the independent producers are different, which is why I want to get your opinion on this. But big oil is underinvesting in infrastructure. You know, they're getting record profits, and people are coming after them saying, "Oh, we need to do an excess profits tax." Well, it's not excess profits. It's only because they're underinvesting, which means in the future there's going to be less development. But I don't know. I'm curious how you see a crash coming, because China's coming back on the market. They're unwelding people out of their doors in their homes, and they're letting people walk around and use live about their lives. So I would think that would bring more demand on the market, even though we're slowing down.
Yeah, no, it could happen. I'm just in everything that I'm seeing, man, I don't see it coming around anytime in the next 6 to 12 months. Now you might have, it might, and now when you and I talk about a crash, for the last 20 years, prices have averaged roughly $60 a barrel. And so when I look at a crash, I look at $40, $35, $40 a barrel, $45 a barrel, not the negative 40. I don't see that happening again. However, when you look at the economic structure of a lot of these companies, most of these companies are small independent producers. A blip in prices like that's like, well, when the price happened, it was April 20th, 2020. When that price crashed right there, immediately you had a large percentage of companies that just were not financially solvent at that point. They were gone. Boom, it wiped them out. Well, then from that point, we tried to get everybody back to the field. Well, your smaller independent producers couldn't pay their people enough to get them back in the field because the government was paying them to stay home. So all of a sudden, that was your next wave of companies that went belly up. Your companies that were able to sustain were the companies that could pay their workers and get them back in the field. And so all of a sudden, here you have Ma and Pa. They've owned this field for 15 years. They have a couple of million in the bank. All of a sudden, they're at a dead standstill. Pa looks at Ma and says, "Ma, here's what we can do. We can go in the bank. We can pull that 2 million, 3 million out. We can bring our people back to the field. We can get to work again. And hopefully in a handful of years, we're back to where we are right now." Or they just say the heck with it and they sell it and walk away. That's what you're having happen. As a lot of these small independent companies are just wiping their hands and walking away and riding off into the sunset, because the largest percentage of your independents were formed in the last 20 years. They've only lived in a world where there's $60 oil. So they built their world around that $60 oil mark. Well, my family I've been doing this since 1994, 1993 was when I got in the business really as an adult. I can remember oil being $8 a barrel. I built my world around oil where the world was $20 oil was what the flat line was. And so all of a sudden, our perspective on the industry is a little different than a lot of other guys that just got in the industry. And so when you look at it, that's what we were talking earlier. And you said, when did you get in the business? And tell me a little bit about your family line. Well, that's where, when you look at various industries, how many industries have you seen where the people leading the industry are third or fourth generation in that industry? And they seem to be a step ahead of all their competition. Well, it's because they grew up in the business. When they got in the business, they already knew more than most people that had been in the business for 20 years. And so all it has done is compounded that knowledge and grown that knowledge. So when the next generation came in, they're standing on the knowledge you've already gathered. Well, this is the third generation of Burrs that have made their living producing American oil. We know stuff about this industry really just instinctually because we've been around it so long. You can look at the field and see, prime example, it is hard to make a good well bad. It's even harder to make a bad well good. Most people don't. That sounds so simple And so 1+1 = 2. Yet you would be shocked at how many oil companies go out there and spend millions trying to turn a lemon into lemonade, when it's probably better just to wipe your hands and basically take the blow and take the loss. And so it just, there's a lot of different things that breed into this, and where I stand and what I see coming. And it's really, you can't just point at one. Yes, if China comes back on strong, you're going to see a full demand. But at the same time, you look at a lot of other countries that are pushing completely away from oil and natural gas. And so you're having a battle of wills on really what direction the world goes, whether we basically scrap everything we've done over the last 50 years and try to start in a new path, or whether we take what we've done over the last 50 years and just make it better. And so that's really the battle you're seeing right now. Now, once again, I all I can tell you is that from my little corner of the world here in Bowling Green, Kentucky, what I think is going to happen, I don't think we can get off of oil. I don't think there's a reason to want to get off of oil. I'm an old movie fan, and one of my favorite quotes was from The Usual Suspects, when he said the greatest trick the devil ever pulled was convincing the world he didn't exist. Well, I look at everything going on nowadays, and I kind of modified that a little bit and said, look, the greatest trick the environmentalist ever pulled was convincing the world that oil was bad. Because that's been one of the greatest tricks they've ever pulled. Because without oil, there is no modern world. And so, like it or not, that's what it is. We need oil. And so I look at what's going on. You realize in America, there has not been a major oil and gas company created off of American production in close to 50 years. Not one. They're all based offshores. They're all based in Africa. They're all based all over the world, but not here in America. Well, there's a chance. Why can't somebody come in and consolidate all this? Start buying up all these properties. If you don't control your energy, if you don't control your medicine, and if you don't control your food, somebody else does. Right now, America doesn't control any of them.
Yeah. Yeah.
And so that's got to change. And there's a lane right here. We were talking earlier. If you had a chance to get into something that you knew everybody needed and nobody else for some reason wanted it, you'd be sitting in a pretty good position. Well, that's the exact scenario we have in the oil and gas industry right now. We have a product that everybody needs worldwide. Everybody needs it. But every time you turn on the television, you see a talking head telling you to run from it. You see institutions running from it. You see ESG scores forcing people to run from it. So all of these people are running from oil. Well, man, I'm a kid in a candy store. We can go through and kick the tires. We don't have to buy anything, but we have now a wealth of potential reserves that we can go through and just purchase what we want. And all of a sudden, we're going to look up 5 years from now. Well, I'll put it to you this way. 2 years ago, we started this. And in 2 years, we've secured what looks to be in excess of 100 million barrels of reserve. Well, in 2 years, we were just getting started. What do you think we're going to be able to do over the next 3 or 4 years? All of a sudden, you're sitting on an American oil company that has a value of 20, 30 billion. That's where we want to go. That's the opportunity that's here in front of us. Now, as they say that you shoot for the stars, you hit the moon. Well, why not? Nobody climbed Mount Everest until they decided to climb Mount Everest. And so that's what we're doing. We're not competing with majors. We're not competing with companies that have limitless pocketbooks. We're competing with roughly 9,000 independent companies that are just like us. Well, man, I'll take that challenge 6 days a week and twice on Sunday. That's the hill we're climbing.
So Jay, in the interest of time, we got to wrap it up in the next 5 minutes, but I wanted to ask you, so for you said you partner up with other people, and I know there's a lot of benefits for investing in oil and gas from a tax perspective. So can you talk about that a little bit, and why investors should consider investing in oil and gas for those benefits?
Oh, absolutely. Well, think about it. If we didn't need well, let me ask it a different way. Have you ever known Uncle Sam to give you something for free? Chances are no.
Not unless you're poor.
Well, yeah, unless you're poor. There's a reason of all the changes, of all the battles that politicians fight, of everything you see on their political platforms, nobody's touching the tax benefits for drilling for oil because they know we need it. And so, yes, oil and gas, the tax benefits for drilling wells are some of the most outstanding tax benefits you can get. It's above line deductions. Now, I'm not a CPA. Go to your CPA, check. Personally, it affects everybody a little different. I want to make sure I say that right off the bat. I can just kind of give you a general rule of thumb. But roughly for every dollar you invest in drilling a well, Uncle Sam's roughly going to pay for a third of it. So you put $100,000 in a drilling program, you're looking at about $35,000 in tax benefits. And that's an above line against your active ordinary income. Now, if I was to tell you to do oil and gas for the tax benefits, you're better off giving your money to the Boy Scouts. You know, you don't do oil and gas for the tax benefits. They just happen to be an additional benefit. Now, you do oil and gas for the revenue. You do oil and gas for what it does for you when you get that oil and start producing it out of the ground. Now, one of the best things you could do is go to our website. It's panex.us/learn. We have an oil and gas 101 primer, just kind of gives you the basic foundation to oil and gas. We have oil and gas 102 that shows you the tax side of oil and gas. We're coming out with a video here in the next couple of months. Just kind of had a wild hair and said, you know what? Let's show people what a morning without oil would look like. And so we're going to put together a good 3 or 4 minute video just showing you what the average person's morning would look like if there was no oil in their lives. And we're hoping to spur people. Not really, look, whether you invest with me or not, that's up to you. Come check us out. See if we're the kind of people you want to do business with. If you don't get that warm, fuzzy feeling about me and my family, I'll be the first one to tell you to keep your money. Don't do it. But you need to research oil and gas because this is an avenue that I truly believe if you don't have a portion of your portfolio in oil and gas, you're missing a tremendous opportunity. Now, when you go to our website, you'll see a little section that says testimonials. These are partners that have their money with us. Just telling you what we do. I'm not going to insult your intelligence and tell you we won every time. If anybody does that, especially in oil and gas, again, they're lying to you. What I will tell you is we come early, we stay late, we do what we say we're going to do, and we leave no stone unturned with one purpose, to make our partners as much money as we possibly can. Because without our partners, we don't have a business. And so every decision we make is geared around that fundamental principle. If it's not good for our partners, we're not doing it, period. And so once you come and look and see who we are, hey, if you want to find out a little more, contact us. I've been told no before. You're not going to hurt my feelings. So don't worry about if it's not something that's for you. Great, keep your money. However, you might find something special and you might find something that if we can pull off what I think we can pull off, we're going to change a lot of people's financial future.
Great. Well, RJ, really appreciate you coming on the show and sharing your wisdom with us. Where can people find more about you? And then I know we'll probably have you back on the future because this oil conversation is not going to stop.
Oh, wonderful. Well, panex.us/learn is the main landing page to get our information. You can find me on, I'm on Facebook, I'm on Twitter, RJ Burr. I'm on Getter. I'm on quite a few of them. Now on Facebook, we actually have a Panex account there where we have all our videos, every piece of, really, we try to post knowledge. We try to post stuff on the oil and gas industry that most people are unaware of, just to really, the worst thing that could happen is not knowing. What G.I. Joe say, knowing's half the battle, and so if you arm yourself with knowledge, and again, don't take my word for it. I'm just a good old boy from Bowling Green, Kentucky. Everything I've learned is through experience and through digging down and making sure that I research myself. Don't take anybody's word for it. Do your own research. We're all smart people. There are a lot of people out there who are pretty intelligent that just don't want to give themselves credit for it. Trust your own common sense. When you see what's going on here, if I can figure it out, I know everybody else can figure it out because it's very simple. 1 + 1 will always equal 2. And it'll never equal 2.1, never equal 1.9. It will always equal 2. And if it doesn't, something's wrong. And you got to check your equation.
All right. Well, Jay, once again, thanks for coming on the show, and we'll definitely have you back.
Well, Kirk, thank you very much, man. If there's anything I can ever do, just let me know.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with RJ. Really appreciate him coming to the show and sharing his wisdom. Always like having people on the show that are really in the thick of it and actually know what's going on, as opposed to us ivory tower types up here who are talking from our high place in the world, looking down and assuming we know all the answers. Anyway, we're getting to the panel portion of the show here. So we have our very own Barb Friedberg. Hey, Barb.
Yes, I am here ready to talk.
Awesome.
Hello.
Well, can't wait to hear your thoughts. And we also have our very own Doug Heagren. Hey, Doug.
Hey, fascinating topic. We've talked about this, you and I, in different ways the last on several of the Money Tree podcasts, and I think it's on the back of a lot of people's minds as they're kind of looking at their utility bills and gas prices. And I like what you said about the ivory tower component of it. I say this a lot about people that have advisors and kind of money managers, sitting in an office somewhere in Urbanville, who says they can watch and manage everything going on with the markets and the stocks. And it's like, can they do that better than someone that's sitting right there with, knee deep, in it every day watching it? Probably not. Someone like this individual who's just feeling and seeing this all the time, 24 hours a day, is a really good resource. And that was a very fascinating interview.
Yeah, thanks, Doug. And for those of you who don't know, that the ivory tower was a little bit tongue in cheek. So
kind of, sort of.
But anyway, so Barb, let's start with you. So what were some of your thoughts from the interview?
My takeaway, because I always like to go to the investing bent, is should we be investing in commodities? Should we be investing in the energy sector in particular? And where do they have a place in our portfolios? So I think that's something we need to think about. Commodities do not have, dividends. So it's like a pure capital appreciation play, kind of like gold, which is a commodity. So I'd like to delve into that today.
All right. Well, that's great. What about you, Doug? What are some of your thoughts from the interview?
I think like what Barb just said, is there a place for it? Obviously, unlike most investing, you may or may not have a direct impact. It may or may not have a direct impact on your daily life, but commodities obviously do. We're all facing this because of the way it trickles down through all the sectors of the economy, whether it's in the production of the goods that we use, it's the ability for us to live in comfort through heating and power, down to just the direct purchase of it through things like gasoline. So I think that I think there's definitely an interesting, as I said, an interesting part of this. It's on the back of a lot of people's minds. Sector investing is something we get a lot of questions about. You know, people are trying to ask, how should I do things differently than, standard allocations? How do I get exposure to this? What's a good time? Like Barb was talking about with no dividends, and you start getting into things like how do you actually invest in that through futures? Futures is a very, very complex beast that has a lot of impact on the price you're actually paying that may or may not directly correlate to what the price of that actually is. And so those are some of the things that I think are incredibly interesting about this particular topic and asset class.
All right. So let's I know Barbie sent around some links prior to the show here, and it was a Wall Street Journal article, which we'll put in the show notes, that talked about the boom in oil production may be drying up. So I don't know if you have thoughts on this, but I know this is something we've talked about a lot in the show. And, certainly when it comes to oil and gas, it's the cheapest form of energy out there that we have. And at the same time, people think it's destroying the planet. So, what are some of the things you took away from that article?
I'm not going to go into green versus not green energy, because even though we're going towards more green energy, and there's pretty much data to support that a lot of the current forms of energy are having a harmful impact on our planet, that's not really my area of expertise. But I also don't think oil is going anywhere soon, at least not the complete eradication of that. And if they're drilling less now in the US and the US is producing less oil, that suggests that oil is going to become more expensive in the future. Now, I think how this applies to us, and then actually, Kirk, I'm going to turn it back to you and Doug, because I know you guys are very fluent in this. But whenever we've got a supply dwindling, we're going to see prices go up. And so I think we have to be prepared that we're producing less oil now. We're going to have to be prepared that sometime in the future, prices are going to go up. So that's going to hurt us personally, because we all still use, most of us do not have electric cars. Most of us use some form of oil in our homes to heat it. We also buy clothes. When he said poly means oil, I'm like, okay, well, oil has produced my whole wardrobe, except maybe the few pieces that are pure cotton or wool. So we're going to be facing higher costs future. And that does raise a question. Do we want to maybe invest a little in this energy sector, either the broad energy sector, which you can get incidentally, Doug, through an ETF if you do not want to be a futures investor, which most of us like to keep it a little simpler. So you could buy like an oil and gas ETF or mutual fund, or you could buy a commodities ETF to capitalize on a potential that prices will be going up and there may be some capital appreciation potential there. So that's my takeaway. I'd love to hear from you, Doug and Kirk, about, do you play this as an investor?
Well, Doug, what about you? Good question.
Yeah, that is a great question. And yes, I absolutely do play it as an investor. I think that the commodities markets are something that, again, is something that touches every aspect of our lives in one capacity or another. And, it goes back to some of the great minds of investing have said, look at what's being used locally. This is a great Peter Lynch saying, look what's being used locally, look what's popular, look what people are talking about. And that right there means you should that might make a good investment. Now, if you're going to try to time the markets, I think there's a different, again, we always say timing the markets, unless you really know what you're doing, be very careful with it, because even those that are experts that try to time the markets often fail. And when you're wrong, you can be very wrong. And so if this is something like, well, I'm hearing about it now, I should jump into it. Well, commodity prices are already very high, okay? And there is some evidence and some charts that some of those prices have kind of come down a little bit. Obviously it would have been great, if you think of 2020, when everything stalled around the world and everybody thought that commodities and, prices and oil prices were practically looked like they were going to go to zero. Well, guess what? We talk about that contrarian. When everybody wanted to run, that's the time to jump in. When everybody now wants in, now the price is already up. Now, do I think we're seeing an end to high commodity prices? No, I do not think we're seeing an end to high commodity prices. But the question of that, kind of looking at like crypto, same thing. Crypto went up to $60,000 a share. Do we think crypto is going away? No. You could have jumped into it at 60 and hoping it would, take you higher. But at that point in time, there was so much, it was already in the upper atmospheres of cost, right? And now there was a lot of downward risk. So I think that commodity investing is something that, again, for most people, don't try to time it. I think there's a piece of it that certainly can be a part of everybody's portfolio. And I think that now, at any point in time, again, through basic reallocation, basic rebalancing, obviously working with someone that really understands the markets, or if simply just buying into an ETF or a mutual fund that has some sort of an oversight. This is an area where I like active management. Okay. Not a passive commodity fund, but someone that actually has a track record of managing these futures because they are so volatile and giving you that exposure without you having to stare at tickers and watch the futures expiration dates and all that stuff, which most people, as much as they think they want to be experts at investing, don't have the time to do that level of capacity. But it's not going anywhere. It may be shifting. Who knows what's going to go on with green energy? I just saw something that posted today about here in Minnesota where I'm at. Xcel Energy is lobbying the Public Utilities Commission to install electrical charging stations all around. They want to help Minnesota get green. But of course, they're asking the Public Utilities Commission to have every electricity paying citizen of the state of Minnesota to supplement that, to actually raise everybody's electric prices to do this. So commodities aren't going away. There's a shift in it. I also want to talk about what you mentioned about poly. I saw something recently, and I wish I could find this fact, but I believe something like 80% of all the plastic that's ever been developed has been developed in the last 20 years. And you mentioned clothing. Listen, it used to be clothing was made out of cotton or wool. Nowadays, all those wonderful stretch pants that people go and pay a ton of money to, Lululemon, the shirts, the sweater that I have here, all have plastic in it. It's actually one of the greatest contributors to pollution is through that lint in your dryer going out into the environment. It's in everything. And for that reason, whether or not we're running out of oil, which we heard 20 years ago was going to happen, and then all of a sudden they found more, or whether it's just because they're not exploring more or political pressures, whatever it may be, commodity demand is up, commodity supply is down, but no matter what, commodities will always be a factor in everything that we have. So I believe it is definitely a place that people should consistently invest in.
Yeah, and Doug, I'm worried about the environment. That's why I don't buy stretch pants. So just wanted to let you know I'm contributing to the solution, not the problem.
I thought you were just worried about everybody's eyes. There's not enough bleach going around the world on the planet to wash that vision out.
Well, I'm also worried about visual pollution, Doug, too. So
worst kind of pollution.
Yeah, we don't need to see that. All right, well, let's get into commodities too, because I think we're talking about investing, and quite frankly, we beat the dead horse every Friday on LinkedIn and every Wednesday on this podcast. When we're talking about energy and the problems there. So I don't think we need to go down this rabbit hole too much, but I do want to talk about investing in commodities in general. So last year, oil and gas did tremendously well and everything else didn't. It was probably the only thing that did well last year. And yet, at the same time, they're not really booming this year. But, if you look at the long-term trends are not going to lie. We're underinvesting in oil and gas, in CapEx, and the things that drive. I saw a chart the other day. I thought it was fascinating. I wish I had it here. I could share it on the show. Maybe I'll put it in the show notes. But it talks about the correlation between the advancement in society and the abundance of cheap and available energy. So you can imagine how far we could go in our society if energy was free. As an example, I know it will never be free, but if it was ever free, imagine what we could do. But when energy is expensive, we can do a lot less because it pinches the purse strings of everybody in our economy. So it's an important sector, and it's important to understand the dynamics, but it's also a political economy. Because you got Saudi Arabia, you got Russia, you got all the oil producers in the world, and it's a constant political battle. So I personally don't like it for that reason. But commodities in general are an essential part of our economy. So, Barb, if you're looking at commodities, and I'll just put another context here, 20 years ago, we used to talk about stocks, bonds, and commodities. Now we don't talk about commodities because they've been out of favor for 20 years. But now they're coming back into favor because of inflation. So, when you think about commodities, my question to you would be, should you add commodities to your portfolio? And if you consider that, how do you do it?
That's a great question, because there's always the question about how much should I diversify? And I sometimes use the robo-advisor models, which are digital investment managers, and most of them choose a bunch of ETFs to invest in to create portfolios for investors according to their risk tolerance. So I look at those and I go, well, there's some companies like Vanguard in their robo portfolio literally have 4 funds. Then you go to Schwab and they have 12 to 20 funds. So both of those are well diversified because one fund has thousands of investments in it. But Schwab takes a different approach, and they go really granular in their robo-advisor. They have a gold ETF, they have fundamental and market weight cap index funds in a variety of different asset classes. So back to your question. So do you need a particular fund? First of all, how you invest in them? I say ETF or mutual fund all the way. It's the easiest and the cheapest way to go. But should you have one in your portfolio? My personal belief is you don't need that much diversification. You're getting access to commodities through just your regular stock funds. And so my personal belief is I like things that at least have a chance of a little dividend, which cushions the fall when the asset class goes down. And in 2022, we all know our stock investments declined in value. Our bond investments declined in value. But some of us were hurt less because of the dividend payments that continued. And so I weigh in and say, I don't think you need a specific commodities fund. But if you are a really active investor and you want to take part of your money and time the market, or you want to play on certain sectors or certain asset classes that you think are going to outperform, I'm not going to tell you don't invest in commodities. So bottom line, it is a personal choice. You can be a successful investor without a commodities fund or without a sector fund. Heck, Warren Buffett said in one of his earlier letters to investors that he is informing his heirs that he wants an investment in 95% of an S&P 500 index fund and 5%, I believe, in treasuries. If he thinks that's diversified enough, you might want to think about it.
Yeah, no, I think that's good advice, Barb. Although I would argue that Warren Buffett is I am not Warren Buffett, so I should not be investing like him.
Yeah, and he probably has a lot more to invest. He has a lot more money than probably all of us put together and multiplied many times over.
Probably.
So yeah, we don't want to invest, we don't want to use him as our sole guide, but you're diversified enough without a commodities fund.
Barb, you said probably. Are you hiding something from us? Is there something you're not sharing? Because I don't know about you. I'm not hiding anything.
I am not. You will never see me put my net worth online. Never. And as an aside, the people who do put their net worth online, do you really believe them?
That's a good point. That's a great point, Barb. Well, thank you for sharing. So Doug, what about you? How would you invest in commodities?
Well, so I do want to counter. Do I think that the S&P 500 is a simple place to invest? I do, but as we've talked about before, in the way the S&P 500 actually works, I'm not so sure I consider that to be a very diversified investment. I mean, for the last 10 years, 80% of the growth of the S&P 500 was tied to one asset class. The top 9 holdings were tech, and then you add Berkshire Hathaway. So no wonder he likes the S&P 500 as the main drivers of its performance. So to me, it's a simple thing because that index will go up, go down, and it should grow over time. But the volatility that you get from it, and especially during the worst years of the S&P, and we've talked about 13 years of negative to flat growth of the S&P is a real issue for most people. Okay. I mean, if you've got billions of dollars and you can afford that flat and you're not going to run out of money during that time because you're not really living off of it, sure, it's a simple, easy place to be. And it's a place where your money isn't going to evaporate because there will always be an index, right? Just going to be different companies in it. And it's better than stock picking. But I would say that, there are reasons to diversify beyond that. I mean, again, I believe in correlation. I believe it does change and you have to be on top of it. I believe that there is a place, we talked about this last week in one of the podcasts, negative correlation, where something should underperform when expected against another asset class. And I believe in the benefits of non-correlation, meaning it kind of does its own thing. But I do think the sector rotation is a very volatile place to be. And so I would not be someone that recommends actively trading in this area. Leave that to others. Understand it, but I think there's a component. I think for one thing, a lot of your global companies, especially in your Dow component, a lot of those companies, not all of them anymore, but a lot of them are truly industrial-based companies. And so as an industrial-based company, what you'll find is that they rely on a lot of basic materials. They rely on a lot of energy to produce what they're producing, which means it is possible, and I'm not saying not any of this is going to come true all of the time, but it is possible that an energy or a commodity-based allocation could give you a little bit of a hedge against the performance of the Dow, all right? Because if energy goes up, it becomes much more difficult for those global companies to be able to produce the goods that they're producing. It becomes more expensive to produce those goods. It makes it more expensive for them to then sell those goods. And while it can be incredibly profitable at one area, it can also be detrimental in terms of volume. And those things sometimes offset. So again, there's a possible diversification there. Now, I will tell you in current momentum, I've been tracking the momentum on some of these things right now. Basic materials, and kind of using the Russell 3000 as a benchmark average, because again, the Russell 3000 is supposed to be taking into consideration not just large caps, but also some inclusion of mid caps and small caps. So it's kind of a decent benchmark of the U.S. stock market, although I think the Wilshire 5000 obviously goes a little bit deeper. If you take a look at what has momentum ahead of the Russell 3000, basic materials are extremely above average, okay, right now. But at the same time, below the Russell 3000 momentum, you're seeing that energy and the Dow, as well as the NASDAQ 100, are both trending with less momentum than the U.S. average of the Russell 3000. And at the bottom of the list, no surprise to anybody with what's been going on in the cost of energy is utilities. Utilities have been, and telecom have both been laying down there at the bottom of the momentum list for quite some time. Although right above that, this shouldn't be a shock to you, Kirk, real estate. Okay. So again, right now, would the energy be a diversifier for the Dow? Not really from a momentum standpoint, but basic materials, which are used by a lot of those Dow components, is really soaring on momentum right now. Now, I'm not telling you to go out and invest in it, because the one thing about chasing momentum, it used to be an incredibly effective play in investing years ago. It's not as effective as it used to be. I think it's still something to monitor, but unfortunately, momentum can, bullwhip very, very quickly, because as soon as computer trading gets caught up on momentum, they not only can drive that momentum, but they can also see that as a way to take their profits and reverse it. So momentum trading is something to watch, and it's a metric there, but I'm not telling you go out and follow what's strong in momentum, because it can reverse on you as quickly as you get into it. And as an average investor, you're going to be the last to know on this momentum. But I do think that as you look at the broad spectrum of where to invest, you can see that diversification. You can see that that reverse correlation. Industrials are doing very well right now. Okay, that's way above average on the Russell 3000. But the Dow 30, which is inclusive of industrials, is below the Russell 3000. So as an asset class of momentum. So again, I do like to see little components, a little bit here to precious metals, a little bit here to commodities, a little bit here to different types of sectors to round out. Because again, just investing in the simple index like the S&P 500, you don't know at that point in time if you are diversified. You could be sitting in nothing but tech and waiting for, and thinking you're diversified and waiting for tech to reverse. If you have other things like commodities in there, it can help give you a little bit of cushion when those things start to go in a more negative direction in the main indexes. So I do believe in investing in it. I believe in investing consistently. Do not become an active trader in it. If you're going to look at doing it, you have someone else who's an active trader take charge, whether that's in a fund or someone that's managing that component for you.
Yeah, no, I appreciate that, Doug. So as we get close to wrapping it up here, sector investing in general, right? We talked a lot about energy. I think one of the challenges that we face in this market is, last year, except for energy, everything did poorly. And, we're getting into a period where it's going to be more of a stock pickers market. And what does that mean? People say stock pickers market, it means different things to different people. For some people, it just means that actually you can generate alpha from picking stocks nowadays. The last 10 plus years, you didn't. You basically picked FANG stocks and you went to sleep and you woke up and like, oh, I had lots of money. I won the lottery. You didn't have to really be good at anything. And if you were a good stock picker, you actually didn't get rewarded. And so it disincentivized people from actually doing their homework. So we have a whole generation of investors that don't know how to value stocks, which would be really interesting. Barb's going to love this. She's going to be walking around like a kid in a candy store picking up values. But how do you kind of look at the diversification model, right? Sector investing is, if you invest in the S&P 500, it's got all the sectors, right, in different allocations, and maybe they're correct, maybe they aren't. But if you're picking a sector, you're really deciding this is the sector that's going to do well. So Barb, how do you kind of incorporate that into your thinking and in your portfolio with sector investing versus just diversifying between broader asset classes?
Research is really clear. First of all, performance is inversely correlated with cost of investments. So typically that's the reason why a variety of index funds, typically 60 to 70% of the time, outperform actively managed funds over the long haul. And to piggyback on what Doug said, diversification is very important. Not diversifying with, I'll have Apple and I'll have Intel, I'll have two stocks in the tech sector, but diversifying across a variety of sectors, across a variety of sizes, large cap, mid cap, small cap, diversifying across across the globe. So I'll have international stocks, you'll have US stocks. That's really important because, as we've all said a million times, when one sector goes up or another goes down, you're going to have the inverse correlation, which will enable less volatility in your portfolio overall. If you are 100% invested in the S&P 5 last year, well, then you lost, 20+% in your portfolio. But if you had some cash there, you lost less. This year, what we're seeing is the large cap growth, which have been in favor like for a decade, are kind of giving way a little bit to small caps, to international stocks. Bonds are finally back. You can get a 4%, 5% yield on bonds. So 2 takeaways. One, most of us don't want to be stock pickers. If you do, have a good time with that. Go on and, you'll be successful some of the time and some of the time you won't. Most of us want a portfolio that's going to perform reasonably well so that we can fulfill our long-term goals. And so it's sensible to hold a diversified portfolio. How many asset classes you have? I have like 7 to 9 in my portfolio. That's on the high end. You can be fine with an international stock fund, a U.S. stock fund, a U.S. bond fund, maybe an international bond fund. That's what Vanguard believes. I like some tilt towards small caps. I like some tilt towards value. I also happen to own RSP, which is the U.S. stock market, but not weighted by market cap. It is equal weight, which means it has a more value bent and it gives a little more attention to smaller cap companies. So for most of us, that's a great idea. But Kirk, back to your idea. What about sectors? What if I think I've got an idea? I know this sector. I know healthcare is about to boom. I believe that this sector is on the verge. Well, I say go with that. Just don't go with it with a big percentage. My personal belief, and many other financial advisors agree with this, is take 5% of your portfolio. Do whatever you want with it. I happen to pick stocks with that because I can't get away from it. I like the act of stock picking. I think I'm smart. I can evaluate a stock, and sometimes I'm right and really make some good picks. If you want to invest with sectors, do it in a small allocation. If you're wrong, it's not going to kill you.
Awesome. Well, thanks, Barb. And Doug, what about you? What are your views on this?
Well, I don't have a lot to add on what Barb said. I think that one thing about that 5 to 10% allocation, I think there's an old saying on investing that unfortunately people forget every single day. We saw it with how much people were invested in the .coms, and then they lost their shirt. We saw it with how much people were invested in real estate going into 2007, 2008. Many of them lost their shirt. And then of course they were going to retire, and they saw the retirement completely blown because they didn't have a plan, which led them to plan to fail about how they were going to get their cash flow and their income in retirement. That caused a whole generation of baby boomers to have to keep working. Many of them still are. Now we take a look at what happened with Bitcoin, and they got all caught up in Bitcoin. And sure enough, people jumped in, put everything they had, stories of people taking out home equity, more lines of credit, fully leveraging their house just to go buy Bitcoin at, $50,000, $60,000 per coin, all to find now that they are, again, losing their shirt on it. Again, do not invest what you cannot afford to lose. It's an old saying. Now, that does not mean that putting your money into, say, the S&P 500 or the Russell 2 or whatever that means, diversified as a main portion, you're not going to lose on that long term, but you still have to have the preparation and the balance between risk investments and safe investments and the ability to get by when things start to get a little bit uncertain. We saw in 2020, I've talked about this before, all of a sudden, in other areas, all of a sudden, all of this boom of real estate and everybody owning Airbnbs and Verbos. And all of a sudden, all it took was 1 month of everything drying up for COVID. And people were crying, oh my gosh, I'm going to lose my house. I can't pay my mortgage. Like, how are you that leveraged? Have cash, have support. So don't leverage yourself. Keep yourself invested. What is a long-term investment should be long-term, and it should never impact you on the short term. If you're there to the time when you need it, that money should be pulled out. For example, I do college planning. If you're going into college and you've got a kid going in the next 2 to 3 years, you shouldn't be invested in the 529 in the or wherever you have it in the markets anymore, because you have what you know you have. And the instant it drops by 20, 30%, you no longer have enough. Don't put yourself in that situation. But if you have a segment that you can allocate, that you want to allocate and put into things that may be volatile, again, that you don't need money now, that you can afford to lose. I was talking to someone the other day and they said, how do I get in this? What should I be putting towards this? And the conversation said, are you okay if it goes to zero? Will you be okay? Because if not, then don't put your money into it. It's that simple. And if you are, be willing to take that bet. Again, sector investing should not be the main component. Neither should tech. We were talking about, just diversification in general. Here's the unfortunate thing. 2 years ago, 2-3 years ago in 2020, right before everything imploded, they started put out lists of what the majority of people were invested in. And the top 10 list of what people were invested in looked like this: Apple, Amazon, Tesla, Microsoft, Facebook, Netflix, Google, and all of a sudden, it was Berkshire Hathaway. So 9 out of 10 holdings, tech, right? That's not diversified. And it looked wonderful when everything was snorting returns until it wasn't. And now all of a sudden, people are crying foul. Prepare yourself, plan accordingly, and the best kind of diversification you can do, contrary to everything we're talking about here, time-based diversification. If you need the money anytime soon, that needs to be conservative and ready to go. If it's longer term, if you can afford to not touch it for the next 5, 10, 15, 20 years, different story. Sector investing should be something left to those that can watch it very closely, that understand futures, and ultimately should never be something you need short term.
Great. Well, thanks, Doug. So we're going to wrap it up here. Barb, final thoughts from you.
I thought this was great advice for investors. And don't forget about cash. Today, you can get 4 to 5% return on your cash. And the principal value is never going to go down. So if you have any money in a savings account that is not yielding you at least 4%, put that money in a high yield savings account. I'm Barbara Friedberg. You can find me at Robo-Advisor Pros, Barbara Friedberg Personal Finance, and on my YouTube channel.
Thanks for coming on the show, Barb. And Doug, final thoughts from you.
Listen, if your cash does go down, is one thing I always tell clients about the safe tank. The risk tank goes up and down. It can evaporate. I show an illustration that shows that tank with no cap on it. Cash falls in the safe tank, and that has a cap on it, which means it can't evaporate. If it does evaporate, pick up the phone, dial 911. Means you've either spent it or somebody stole it. Okay, that's the wonderful beauty of cash. It is there, it is ready to go, and most people, unfortunately, do not have balance in their financial life. They do not have balance into their retirement. Prepare that balance. Have things that are allocated that are going to be available and readily known. This is the best type of insurance you can have. And also, of course, allow yourself to allow those things that you have invested for risk. Every investment you have has some sort of a risk. Allow those things to work for you. And since I already mentioned it, just how you can find a little bit more about me and what we do. I talked about the college planning. I'm a co-founder of procollegeplanners.com. We do help families find the right college at the right cost so that your child can have extraordinary opportunities. Go to procollegeplanners.com right now. If you're not going to do anything else, go there right now and download our free college planning checklist, 2022-2023 college funding data. This information gets updated annually, so it is pertinent for what's going on right now. And as soon as the new data comes out, we will publish the updated version. If what you thought you knew to be true about college, if what you thought you knew to be true about paying for college, if what you thought you knew about saving for college all turned out to be untrue, when would you want to know? If you're not finding those answers today, you're probably not playing the game, and college planning is a game, correctly. And unfortunately, you're going to lose. Let us help you at least even the playing field. procollegeplanners.com.
Great. Thanks again for joining us, Doug. That's the show for this week. Thank you again for joining us in Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.